Markets face an early year stress test, starting with Venezuela. Traders are back for their first full week of 2026, and Venezuela is setting the tone. The US move to oust President Maduro pushed the dollar higher, hitting a 3.5-week peak against the euro. But attention is quickly shifting. A heavy week of US data now looms large and could prove key in shaping the Fed's next move. Francesco Pesole is an FX strategy at ING. So Francesco, as traders are gravitating to the greenback as uncertainty swirls around Venezuela, is this really a flight to safety or just seasonality bias?
I think this is, to some degree, a flight to safety. It's not huge. I think markets are still trying to understand what the implications are from a geopolitical perspective, from a risk allocation perspective, and from an oil perspective, obviously. I think for now, it's understandable that when you have sort of a shock, a geopolitical shock like the one we saw over the weekend, the dollar tends to trade on the strong side. But as you mentioned, there is seasonality in January that is generally positive, so that may be contributing. It looks like that when looking at the short-term outlook for the dollar, there is a clear bullish bias in the moment.
So as the implications of a regime change become clearer, what will FX markets be watching most closely?
In the short term, obviously, the focus is, the relationships between the new government and the U.S., the new government of Venezuela, obviously. If the indications are that this will be a smooth transition with no further military intervention by the US. We think that some of the moves that we've seen in the dollar might be sort of pared back to some degree because markets price out some geopolitical risk. Obviously, the other way around, there's more upside potential, not only for the dollar, but for other safe haven currencies, the Swiss franc, but also gold. Should we see sort of like relationships continue to deteriorate between Venezuela and the US, and the US intervening militarily again? I think in the longer run, the implications that will matter the most for the dollar and the FX market in general will be about oil. So will we see more supply coming into the market in the next few years? If markets start to price that in consistently and convincingly, then that can be a negative for the dollar if indeed oil prices come under pressure.
Well, let's switch to the data now. The new year brings the next installment of key US jobs data this Friday. What are you expecting, and could it be enough to shift expectations for Fed policy?
I believe that as long as we are, close to consensus around 50,000, markets will remain pretty happy with what they're pricing at the moment. That is some probability, just above 50% of a cut already in March. And then sort of like the terminal rate between 3 and 325. That could remain the case. Obviously, to see a meaningful shift on the dovish side with those pricing, I believe that those pricing expectations, I believe that we'll need to see somewhere below zero, really, to have markets fully pricing in March. Cut by the Fed.
Well, the dollar ended 2025 with its worst annual performance in 8 years, and many arguing that there's more downside ahead. Do you agree?
Yeah, so we have a gentle downward profile for the dollar. We think that when looking at euro dollar, we could be heading to 120 towards the second half of next year. I think in the short term, the picture is a bit more nuanced. We discussed seasonality that is positive for the dollar at the start of the year. Obviously, these geopolitical developments can also provide some support. But heading into sort of like looking ahead at the whole year of 2026, we believe that there are still downside risks. There's still some hedging flows that can damage the dollar, and obviously anything on when it comes to Fed independence with the change of the chair and potentially a more dovish stance by the Fed, despite data not justifying it. Obviously, that is all negative for the dollar as it can push down real rates.
So finally, Francesco, let's talk about some of the moves over the Christmas break. And Yuan moved beyond the key 7 per dollar level in the tightly controlled onshore market. It was the first time since 2023. So is Beijing comfortable with further appreciation coming into the new year?
To some extent, possibly. I don't think that. I think what the whole 2025 told us is that the PBOC and Chinese authorities in general were focused on establishing the global role and the role as a stable currency of the yuan. That obviously was very successful. attempt. And what we're seeing now is perhaps going a little bit too much on the strong side. So we think that from now on, we could see a little bit of a change in the approach by the PBOC, and perhaps starting to counter a bit more those downward moves in dollar CNY.
That was Francesco Pesole from ING. Don't forget, you can watch more videos on Reuters.com.